Hi, I'm Audie. Ever look at a stock market chart and just see a mess of red and green sticks? It looks like math, but it's actually a psychological battlefield. Those charts are decoding the deepest human emotions: fear, greed, and total exhaustion. Today, we're learning how to read the footprints of the market. This isn't a modern Wall Street invention. It was created by Munehisa Homa, an 18th century Japanese rice merchant. Homa realized that markets aren't just about supply and demand. They're driven by an eternal cycle of yin fear and yang greed. Here's the crazy part. We've moved from physical rice ledgers to digital ETFs on our phones. But the human brain and our emotional panic hasn't changed one bit in 300 years. Every single candle you see is the physical footprint of a specific war waged between buyers and sellers. The thick center is called the body, which is the boxing ring where the main fight happens. Its color tells you who survived the day: green for buyers and red for sellers. The lines sticking out are the wicks. The upper wick is the scar, proof of a failed advance where price was rejected, while the lower wick is the trampoline, proof of absorbed panic where a breakdown failed and buyers bounced the price back up. Sometimes, a single candle can tell you exactly who is winning the war. A doji looks like a cross and represents total market confusion where neither side can gain ground. A hammer indicates smart money is stepping in as extreme fear is absorbed by strong support. Conversely, a shooting star shows that greed has hit a wall. Buyers are exhausted, signaling a potentially violent shift where sellers take over. Homa moved beyond individual fights to map out 5 specific stages of mass psychology, known as the Sakata Five Methods. These patterns occur when the collective emotions of the market reach their absolute breaking points. These 5 stages, Sanpei soldiers, Sanzan mountains, Sanku gaps, Sanpo rest, and Sansen rivers, help us predict when a crowd is about to follow a trend or run for the exits. To find the top or bottom of a market, we look at the Exhaustion Matrix. Sanzan 3. Mountains marks the end of greed. The crowd believes prices will rise forever, but fails 3 times to break a new high, signaling that big institutions are starting to sell. When you see this, it's time to exit your long positions. On the flip side, Sanson 3 Rivers marks the end of fear despite bad news. The market refuses to go lower, meaning sellers are exhausted, and it's time to enter a trade as fear turns to hope. Senku, or the 3 gaps, represents an explosion of market madness. The first and second gaps are breakaway and runaway gaps, where the crowd rushes in due to massive news, making the trend violently strong. However, the third gap is the exhaustion gap, which is a final burst of pure FOMO, fear of missing out, or panic, where the market disconnects from reality. Homa's insight was that this madness cannot last when that third gap appears. Stop buying, take your profits, and prepare for a crash or reversal. Sanpei 3 soldiers consists of 3 unbroken candles that signify the unstoppable footprint of big institutional money driving a major trend. This isn't something retail investors can do alone. It shows deep conviction. However, even the strongest trends need to breathe, which is where Sampo 3 Methods comes in. This is a rest phase. Do not panic sell during this healthy breather, as long as the price doesn't break below the initial surge. When power shifts instantly, we see patterns like Tsutsumi and Harami. Tsutsumi engulfing is a complete takeover, where a sudden, massive influx of buying pressure overruns the sellers, shifting psychology from despair to aggressive accumulation. Harami, meaning pregnant, shows a loss of momentum where the market is contracting and breathing heavily, suggesting that a reversal is currently gestating and about to be born. The Hoshi, or star, is the pinnacle of the market's arc. It happens in 3 steps. First, a greedy surge drives a long candle. Second, a tiny, gapping star appears, marking the exact moment the dominant force spends its very last dollar and is left stranded. Finally, the seizure occurs. A massive opposite candle plunges deep into the first one as the opposing force violently takes control of the market. It is important to remember that technical analysis only tells you when the crowd is going crazy. It is merely a diagnostic tool. True market mastery requires internal discipline. Risk management is the only thing that prevents you from joining the madness and losing your capital when everyone else is panicking. Homa's first rule is that resting is also a form of trading. You do not always need to have an active position. In fact, boredom trading is one of the fastest ways to destroy your capital. Holding cash is a strategic, powerful, and defensive stance that preserves your money for high-probability setups rather than gambling on market noise. To survive, you have to fight your own biological instincts. Rule number 2 is the 3-day rule circuit breaker. Never chase a runaway surge, but wait 3 days to see if it consolidates or if it's just an artificial, euphoric trap. Rule number 3 is trading opposite emotions. Your natural instincts are flawed because an extreme urge to buy usually marks the market top, while extreme terror usually marks the absolute bottom. In the modern world, we apply these rules through a phased investing funnel. Instead of a lump sum entry, which carries high emotional risk, you should scale into positions over time using tranches to keep extra cash dry powder for dips. Always use strict stop-loss orders placed underneath reversal patterns to cut the emotion out of a failure. Technicals tell you when to act, but risk management dictates if you survive. Ultimately, the market is a living organism, constantly cycling between fear and greed. By learning to read the psychological footprints left behind in the candles and mastering your own internal discipline, you stop being a victim of the crowd. You move from following the madness to becoming a master of the market. Just remember, trading involves risk and isn't for everyone, so treat this as an educational guide for your financial journey. Investing in options trading involves significant risk and are not suitable for all investors. The strategies and concepts discussed are provided for educational and informational purposes only and do not constitute financial, investment, or tax advice. Before implementing any investment approach, it is essential to consult with a qualified financial professional to ensure it aligns with your specific risk tolerance and financial goals. Past performance is not indicative of future results, and market conditions can change rapidly.